Exercise 1716. We need to record pension expense, gains and losses, funding, and payments to retirees. Let's start from pension expense. Requirement 1A says, determine pension expense. First, we have service cost. From here, the table says, the service cost is $80 million. Okay. So here we have $80 million of service cost. We also have interest cost. Interest cost is calculated by discount rate, 7%, multiplied by beginning PBO. Beginning PBO 600, so 7% of 600 is $42 million. Pension expense also includes amortization of prior service cost. Here it says prior service cost at the beginning of the year is $28 million. At the end of the year of 2018, we need to amortize this $28 million. They already calculate for us $4 million per year. So amortize prior service costs, $4 million. And then we need to amortize net gain or losses stored in AOCI. At the beginning of the year, there was net loss in AOCI for $80 million. When we amortize it, SEC and FASB allows the company to amortize only the portion exceeding core rider. What is core rider? The higher of 10% of plan obligation or plan assets. So 10% of PBO is 60, 10% of plan asset is 40. The higher of these two is 10% of PBO, 60. So net loss during the beginning of the year, 80 million minus 60. We only need to amortize $20 million for 2018. How many years are remaining for employees to serve the company? Here it says on average, remaining service year for the company, for the company by all the employees is 10 years. So $20 million divided by 10 years, each year we will amortize this net loss by $2 million. So amortization of net loss, $2 million. And finally, we will reduce pension expense by expected return on plan assets. Expected rate of return is 10%. So 10% multiplied by 400, 40 million or $1,000 will be used to reduce our pension expense. So expected return on assets minus 40. Let me check. 10% out of the beginning plan assets, 400, so 40. That's correct. Therefore, our pension expense is $88 million or $1 million. And then how to record our pension expense. Again, the pension expense is a debit item, but we leave it blank because it will be the last plug-in. On the debit side, we have expected return on plan assets. So debit plan assets, the amount is 10% of expected rate multiplied by beginning balance of plan assets, 400, so result is 40. On the credit side, we have increase of PBO based on service cost 80 plus interest cost 42, so 122. And then we have amortized prior service cost. and we are given by amortized prior service costs by $4 million every year. So put $4 million. We also calculated amortized net loss, that portion exceeding corridor 80 minus 60, 20 divided by 10, so $2 million will be credited. And the last plug-in for pension expense, 122 plus 4, that is 126, plus 2, 128, minus 40, 88. The second journal entry says, record the change in plan assets. The change in plan assets is the difference between expected return and actual return. Actual return was 8%. Expected return was 10%. So there is a loss. Your actual return is lower than your expected return. There is a loss on the plan assets by 2% multiplied by 400 at the beginning. So we have a loss of 2 multiplied by 4, $8 million. Since it's a loss, we debit that loss into other comprehensive income and decrease plan assets on the credit side. Once again, 2% of beginning balance, 400, so $8 million. The third journal entry says record a change in PBO. So the change in PBO here, service cost, interest cost is already recorded in pension expense. But here we have a new gain on PBO. The number in parentheses means gain. So a gain on PBO means the liability PBO is decreased. If it's decreased, we debit PBO. So debit PBO and credit a gain by $14 million. Record the cash contribution to plan assets. So the employer deposited $90 million to the plan assets for employees. That is a decrease of cash and increase of plan assets. So debit plan assets and credit cash for $90 million. And then we need to record the retiree benefits paid. So here in the table, they paid retirees $38 million. It decreases PBO as well as plan assets. To decrease PBO, we put PBO on the debit side. To decrease plan assets, we put plan assets on the credit side. For the amount, $38 million.